Hi, so for today we're going to discuss prior period errors. Errors can arise in respect of recognition, measurement, presentation, or disclosure of elements of financial statements. Financial statements do not comply with IFRS if they contain either material errors or immaterial errors made intentionally to achieve a particular presentation of an entity's financial position, financial performance, or cash flows. So immaterial errors are normal. However, if it is done with intent, that means fraud, it will make the financial statement erroneous. Potential current period errors discovered in that period are corrected before the financial statements are authorized for issue. So it is corrected immediately. However, material errors are sometimes not discovered until a subsequent period, and these prior period errors are corrected in the comparative information presented in the financial statements for that subsequent period. So, as required by PAS 1, you're going to present at least two periods, the current period and the prior period. So, if the error was discovered in the subsequent period, you're going to restate the prior period presented. So, prior period errors is governed by PAS 8, together with accounting policies and change in accounting estimates. According to PAS 8, a prior period error refers to omissions from and misstatement in the financial statements for one or more period arising from a failure to use or misuse. Thus, it covers both the mistake and intentional fraud. Reliable information that was available when the financial statements for those periods were authorized for issue and could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. So examples for these prior period errors includes mathematical mistakes, mistakes in applying accounting policies. Take note, this is different from a change in accounting policy. Mistake in applying an accounting policy is literally mistake in the interpretation or in applying a certain policy. If you have been applying a certain policy and change it because of a requirement of another IFRS, that is change in accounting policy. You also have oversights, misinterpretation of facts, and fraud, of course. So this is not exclusive, it includes other items as well, like sliding error, transposition error, and the like. So, how errors are corrected? So, errors are corrected through retrospective restatement. Now, in past 8, you have several terms provided. You have retrospective restatement, you also have retrospective application. Retrospective application refers to a change in accounting policy. That's what you apply retrospectively, apply a policy. But for errors, you're not going to apply, but rather change or restate. So these terms should are specific to the purpose. So for errors, you have retrospective restatement. For change in accounting policy, you have retrospective application. So retrospective restatement is correcting the recognition, measurement, and disclosure of amounts of elements of financial statement as if a prior period error had never occurred. The errors can either occur in the current year and discover in the current year, in the immediately preceding year, meaning it was the error was made in that year and discovered um, in the subsequent year, or errors can also occur prior to immediately preceding year. So let's just say you have in the current year 2020, in the immediately preceding year it's 2019, prior to immediately preceding year, so it covers all years before 2019. Now, why is it important to distinguish or to differentiate errors committed in the immediately preceding year and prior to immediately preceding year? You'll know later because the application or the methods are different for the two. So when are they corrected? So according to PAS 8, the first bullet I just inserted this one. It's not in the standard. For errors committed in the current year, of course, and discovered in the same year, it is corrected through a correcting entry. I'm sorry, not adjusting entry. It should be corrected through a correcting entry. Now, for errors committed in the immediately preceding year, okay, you're going to restate the comparative amounts for the prior period presented in which the error occurred. So, for example, your financial statement covers the year 2020. As required by PAS 1, you are going to disclose a comparative information. So, you have the 2020 financial statements, and of course, you have to present the comparative period 2019. So, if the errors was committed in 2019, you are going to change the balances. You're going to correct, you're going to restate the items in your 2019 comparative period. That's what we call restating the comparative amounts for the prior periods. Now, what if these are errors which refers to years before the immediately preceding year? So what the standard requires you to do is you present a third balance sheet. However, for the date, so for the current year, you have December 31, 2020. For the immediately preceding year, you have December 31, 2019. The third balance sheet will be dated January 1, 2019, not December 31, 2018. It will be January 1, 2019. Since since the errors refers to items in a financial statement before that January 1, 2019, all accumulating changes will only be reflected in the beginning balance of retained earnings. So all changes or corrections or restatements, the net effect will be reflected in the beginning balance of retained earnings. So the balance of retained earnings in January 1, 2019. So if the error occurred before the earliest prior period presented, restating the opening balance of assets, liabilities, and equity for the earliest prior period presented. So here's a diagram for prior period errors. So prior period errors, you have balance sheet accounts only, income statement accounts only, and mixed balance sheet and income statement accounts only. We're going to discuss this line by line. So balance sheet accounts only, you have an example, debiting machineries instead of service vehicle. So balance sheet for the current and succeeding years would be incorrect. We'll show that later. Then you have income statement accounts only, which only involves income statement accounts. Then you have the mix. When you say mix, one is an income statement account, the other is a balance sheet account. So mix balance sheet and income statement account can either be counterbalancing errors and non-counterbalancing errors. So examples, you have purchases. Uh, when there's an overstatement or understatement of purchases, most likely that's a debit. That's a debit of purchases, credit to cash or accounts payable. So one income statement account, which is purchases, and one balance sheet account, cash or accounts payable. And then later it will be close to retained earnings. The purchases account will be close to retained earnings. So you have it there. Non-counterbalancing errors, you have an example misstatement of depreciation. Of course, let's just say you omitted a certain depreciation for that year. So one, you have depreciation expense and income statement account, and you have accumulated depreciation, a balance sheet account. So let's start first with balance sheet accounts. So balance sheet accounts errors only includes balance sheet accounts. So both must include balance sheet accounts. So what's the effect in your financial statement? The income statement for the current year is correct since it only involves balance sheet accounts. However, the balance sheet for that current year would be erroneous. So though the total balance is the same, the individual items or the individual amounts concerning certain accounts would be erroneous. Then you have immediately succeeding year, okay, succeeding years. Now there's an asterisk here because it may affect income statement. It would depend on the error you make. So for example, um, instead of debiting machineries, you debited service vehicle, and both accounts have different useful life, you might also commit a depreciation expense error. Okay, so that would depend. Here's an example. In the current year, the entity made cash sales to some customers. However, instead of debiting cash, it erroneously debited accounts receivable. So in this case, you had cash sales. Proper journal entry should have been debit cash, credit sales. But instead, the bookkeeper made a mistake and debited AR and credit sales. The credit to sales is in no way in error because it's correct to credit sales. However, instead of debiting AR, you should have debited cash. So for that year, current year 2020, the AR account is overstated while cash is understated. So the income statement is correct, of course, because the sales was correct. The balance sheet is also correct, meaning the total assets is the same. However, the individual balances, specifically the balance of cash and the balance of AR, are incorrect. For 2021, income statement is still correct, assuming there are no other mistakes committed next year. And the balance sheet is correct, meaning the total asset is the same, however, still the individual balances are incorrect. So this is under the presumption that no correcting entry have been made. So if it was discovered in 2021 and it was corrected, the correcting entry, oh sorry, so to correct it only needs a reclassification entry. You're going to reclassify the mistake to the correct one. So in our example, you debit cash, credit AR. So this will correct the understatement of cash in the overstatement of AR. So if you made the correcting entry in 2021, all succeeding years will have a correct balances. Next is income statement errors. Income statement errors only includes income statement accounts. So the income statement for the current year, actually the income statement for the current year is correct, meaning the net income is correct. I'm sorry. Net income is correct. However, the individual balances is incorrect. The balance sheet, since it only involves income statement accounts, it does not affect the balance sheet. So it's correct. In fact, even the retained earnings is correct. Because your net income is correct, it follows the retained earnings is correct. And it only affects the current years. So what are the effects? So if discovered before closing the books, then reclassify. If discovered after the books have been closed, no need for any correcting entry. Balance sheet accounts and income statement accounts are correctly stated. Actually, balance sheet accounts, yeah, after closing the books, the balance sheet accounts. So the balance sheet accounts is correctly stated. The net income is correct. However, the individual balances are incorrect. So here's an example. In the current year, an entity mistakenly debited repairs and maintenance instead of miscellaneous expense. So for the 2020 current year, repairs and maintenance accounts is overstated, while miscellaneous expense is understated. So the income statement is correct, meaning the net income is correct because they are both expense. Either you put them in repairs and maintenance or in miscellaneous expense, it will not matter because they are all expense. Thus, your net income is correct. However, the individual balances is incorrect. So balance sheet is correct since net income is close to RE account and the net income is correct, then the RE is also correct. Since it does not involve any other balance sheet accounts, it does not affect balance sheet at all. So 2021, both income statement and balance sheet is correct, assuming um, there are no mistakes committed during that year. So if it was discovered in 2020, this would be your correcting entry. If it is discovered in the same year, debit miscellaneous expense, credit repair and maintenance expense. This is to correct the understatement of miscellaneous expense and overstatement of repairs and maintenance expense. However, since they are both expense, they really do not affect the net income at all. That's why if discovered in the succeeding year in 2021, no entry is needed because these accounts, miscellaneous expense and repair and maintenance, are close to retained earnings account. And your retained earnings account is correctly stated because your net income is correctly stated. So there's no entry needed.